Hello and welcome to today's webinar, Startup Accounting Essentials, presented by Early Growth Financial Services. My name is Patty Montoya and I'll be your moderator today from the Early Growth Financial Service team. I have a few quick notes before we get started. The webinar will last about an hour and that includes time at the end for questions. So feel free to type your questions into the control panel and we'll answer them in between slides. The next thing to note is that this webinar will be recorded and sent out to all registrants with the slide deck within 48 hours. You can also find this recording and all of our recordings on our YouTube channel, Early Growth. Now, before I pass this off to our speaker today, I'll like to tell you a bit about Early Growth. This is a quote from our founder, David Ehrenberg, and a few of the clients we've worked with. And here is a quick description of what we do. We are an outsourced finances and accounting firm. We work with early stage companies, helping them with everything from day-to-day accounting to financial forecasts to taxes and valuations. Now, without further ado, I'd like to introduce our panelist, Sirk Roh, who will tell us a bit about himself and kick off today's discussion. Sirk, it's all yours.
Thank you very much, Patty. Hi, everyone. Thank you very much for spending time with us today. I know that you guys are all really busy, and so we're really appreciative that you're taking time to on this webinar. A little bit about myself. My name is Sirk Roh. I am a consulting CFO with Early Growth Financial Services. I've been with the firm for a little over 5 years, and with Early Growth, I've been a consulting CFO for many clients in different areas. Most of them are in high tech. Being based here in the Bay Area, when we say startups, it usually means high tech. And so I work with a lot of software companies, some hardware companies, as well, some service companies and platforms. And prior to joining Early Growth, I served as different levels of financial management at both startups and larger tech companies, CFO, VP of Finance, Director of Finance, those types of things. And so I've been working with different types of companies. And here with Early Growth, I've been working with a lot of early stage startups, maybe some of them getting started pre-funding or as they're closing a first round of funding. And we usually work with them, with our clients until they get to the stage where it makes more sense for them to hire someone like myself internally on a full-time basis. And so let's just go ahead and get started here. And just a little bit of a precursor on the actual presentation. So we're going to be spending time today talking about kind of the accounting side of things, and I know that's not the most exciting part of a startup, but it is very important. We'll touch upon kind of what you want to do when you're first getting started prior to raising a round of financing. We'll talk a little bit about what you need to be doing from an accounting and financial planning perspective as you go through a fundraising round, and then we'll talk a little bit about what your needs are going to be and what you should be focusing on from an accounting perspective after you raise a round of financing. And so as you can tell, that we're kind of focusing a little bit more here on startup companies that are ultimately going to be raising outside financing. And so for those of you who are kind of interested more from a, maybe an individual company, service company, consulting company, maybe just a mom and pop shop, some of this is probably not going to be relevant, but I think you'll still find many parts of this that are going to be helpful to you. And for those of you who are looking at this as kind of the initial stages of a multi-year road and journey where you're going to be growing your company and raising external financing, I think that you'll find this very valuable. Okay, so let's go ahead to the next slide. Prior to funding, basically what we want to do is we just want to set up the company, right, so that we are going to be able to grow the company in the future. And from an accounting perspective, first and foremost, that obviously means setting up a bank account and making sure of the one thing, which is you want to make sure that you're separating your personal and business expenses. And there's lots of reasons for that. But basically, all of the activity related to your business should be captured in one system, so that you know how much money is being spent, how much money is being generated from your business, as opposed to, purchases that you may be making, or services that you may be acquiring for your personal for your personal use. And so set up a business bank account, and if possible, get a business credit card as well. And there's two parts to this. One is obviously creating an audit trail so that you can prepare tax returns on an annual basis for your business, as opposed to personal. And then there's also a separating of the personal and business expenses from a legal perspective. And so if we go to the next slide, we can kind of start on that. And the main thing here, the key takeaway here, is that for most of us who are going down this route of setting up a company, especially if you're going to be looking at external financing, we need to make sure that business expenses, the corporate veil, is completely separated from your personal. And it's not only from an accounting perspective, but from a legal perspective as well, because we've seen situations where a founder gets started and initially they may say, well, I'm not sure how this is going to go, and I don't want to go through the effort of setting up a checking account, a separate checking account. So I'm just going to go ahead and just use my personal checking account, while we get started. And that might make it easier to get started, but over time you'll find that that's going to cause problems, especially if you run into any legal issues where, one of the reasons that we set up a corporation is to segregate your personal liability from your corporate liability. And if you're not separating your personal and business expenses from an accounting perspective, then there's reason that lawyers might be able to go in and say that, hey, listen, you as an individual are one and the same as the company. And if your company is getting sued, you might be able to get sued individually as well. So just a key takeaway here is you just want to make sure that you want to separate out your personal and your business expenses. Okay, then if we go to the next slide, we'll talk about a little bit of record keeping. When you first get started, you probably don't have any revenue. You obviously have some expenses. You may be paying yourself. You may be hiring someone initially, or you may not. You may just be kind of doing it on your own. But whatever way you go, you just want to make sure that you're starting to keep your record keeping, right? And we'll talk a little bit about accounting systems later on, but I highly encourage, even when you're first getting started, is to just use an accounting system such as Intuit QuickBooks. There's others as well. Xero is another well-known one. We at Early Growth, we love QuickBooks just because of ease, the cost, the ease of setup, the ease of entry of information, the ease of reporting, downloading of data. And like I said, it's very, very easy to get started and very, very cost effective. So as you're collecting payments or as you're expending money, you want to try to stay on top of those transactions and try to get those entered into an accounting system. If you're not comfortable with an accounting system and it's too early for you to get started, using outside help, then obviously even something as simple as a spreadsheet, an ongoing spreadsheet where you're keeping track of these things, will be helpful when we are ready to move to an accounting system. If you're paying payroll, if you expect to have payroll, or if you have payroll, then we highly recommend that you sign up with an HR or a payroll service provider. There are many of them online now. The likes of Gusto and as well as other ones, but there are so many now. Software as a service platform service that you can use for this. You don't want to be putting yourself in a situation where you try to save a little bit of money by doing this on your own, because there's a lot of problems that you can run into, especially as it relates to payroll taxes, both withholding and then filing of the reports and paying of the payroll taxes, that it just doesn't make sense for you to be doing it. And again, if you look at kind of the different options, you'll find that the cost of doing something like this is very, very cheap. And so don't skimp on that. And then the final thing here is just staying on top of stock records. Initially, if it's you and a partner, then there isn't a whole lot to worry about, but just making sure that you're staying on top of it. We'll talk a little bit more about kind of what you might want to be doing as you get ready to raise a round of financing or afterwards. Okay, and then the next slide is just, for expenses, you just want to keep records, both from an accounting software or Excel spreadsheet, but you also want to keep records of receipts and invoices. And the IRS requires that for all expenses of $75 or more, that you're supposed to keep a paper trail. And people ask about, well, what kind of system is best for keeping these kinds of records? And I'll say that now more and more more companies are going paperless. We think that's a great idea. There's really no reason to keep folders and folders of hard copies of invoices and receipts. There's lots of platforms. We'll talk about some of those later on that you can use that will keep your paperwork down, as well as all of your documentation in an easily accessible and easily auditable place. Okay, the cap table, next slide, Patty. Yes.
We have some questions.
Sure.
The first one is, if startups didn't have any revenue, how to file tax returns?
So you still want to file tax returns because and for your tax returns, you'll basically report that you have no revenue, but you have expenses, right? And so you'll have losses, and you won't owe any taxes at a federal level. For California, there's a minimum annual kind of a franchise or state fee that you will have to pay. But if you're registered, if you are incorporated as a company, you will have to file tax returns regardless of whether you have revenue or not.
And then the second question is, can you share invoice example for international contractors?
I'm sorry. Say that one more time, Patty.
Yes. Can you share invoice example for international contractors?
I'm not sure what that means. I'm not sure whether the question is about different currencies or English versus different languages, but kind of the same thing. I would think that you would kind of do the same thing, right? An invoice would come or by email. And you would, either take a scan of it if it's a physical invoice, or you would just download the email if it's an email attachment, and you would, kind of keep track of it, in whatever online document depository that you're using. I'm not sure if that's answering the question, because I'm not 100% sure of what the actual concern is. But hopefully, maybe the person who asked that question can clarify. We can get to that as well. Okay. So next slide, Patty. Okay. So the cap table is also something. And again, for those of you who are not going to be raising outside capital, then this isn't going to be a big issue. But for those of you who are and who are setting up a C Corp so that you can have multiple classes of stock, both common stock as well as preferred stock, you're going to obviously want to keep track of it. You have to keep track of it. At the very early stages, like I said, if it's just you and a founder or you and a few employees, it's very, very easy to just kind of keep track of that, in a spreadsheet. But as you go through rounds of financing, you'll find that it gets obviously much more complicated, both from different rounds of preferred equity financings, as well as giving out stock options and warrants and things of that nature. And so at some point, you're going to want to move to a cap table service, and we'll talk a little bit about that in the future. But there's companies like CapShare and Carta out there that again are SaaS companies and SaaS services, which does a fantastic job of not only keeping track of all the equity, but of all the reports that need to be generated. Some of the valuation work that should be done on an annual basis is easy to do once you start using this software. And so we'll talk a little bit about that. but it's a very big, at pre-funding, it's not as big of an issue, and you probably don't need to go down that route. Okay, and then next is just compliance and obligations, and someone already asked about taxes, but you will need to still report once you incorporate and once you are an entity, you will need to file tax returns on an annual basis, both state and federal taxes. You'll obviously need things like business licenses and registrations. You'll, like here in California, you have to file with the Secretary of State. If you are regardless of whatever kind of corporation you are, you're going to also have to do filings on an annual basis to report your corporate status. Most companies who are ultimately going to be raising financing from the outside will set up as a C Corp, because a C Corp will allow you to have multiple classes of stock, which you need to do in order to actually give preferred stock to investors and common stock to yourself, for example. Most or many companies, I'd say the majority of companies out there incorporate in Delaware. You don't actually have to do business in Delaware. Delaware makes it just very, very easy and simple and cost effective for you to incorporate, which is one of the main reasons why most or many companies choose to go that route. But in terms of the actual process and choosing which legal entity, what type of legal entity you want to set up for yourself, this is one that you're going to want. This is more of a legal question. You're going to want to talk with attorneys to figure out what makes sense for your company as you think about what you think is going to, or what kind of company you're going to have and what kind of future you expect. Okay, so pre-funding, those are kind of the main things, right? So let's kind of recap a little bit. So we want to make sure that we keep track of our expenses. If you if you have revenue, if you're generating revenue immediately, then you obviously need to keep track of revenue. And so once you actually have revenue, you'll definitely want to get yourself set up with an accounting software like QuickBooks. You'll want to keep track of your cap table. And you want to make sure that you are meeting your compliance requirements, right? So your taxes, registrations, and filings. So those are the main things that you need to be worried about. And obviously, we don't even get into the whole cash part of it because that's obviously an issue as well. Okay, and then next we'll talk a little bit about fundraising prep, right? So now we're at the kind of stage. Yes, Patty?
Can we ask some questions before we move in?
Absolutely.
Most of CPAs sign off books for both state and federal tax returns?
No, you don't need a CPA to sign off on them. We obviously encourage you to use a tax preparer who is knowledgeable about your kind of business, and make sure that they're a business tax preparer as opposed to an individual tax preparer. So you don't necessarily need a CPA to sign off on tax returns. You just want to make sure that you find someone who's knowledgeable and experienced and can do a thorough as well as cost-effective job for you.
Great. And the second question is, they say, my business is set up as an LLC. My partner is in Colorado and I'm in Connecticut. Do we have to register our business and get business licenses in both states?
Yeah, so this, I would say, so I think I can give you a 90 to 95% accurate answer, but I really, really encourage you to talk with your attorney. Who probably helped you set up your LLC. Yeah, but I think the answer is yes. You probably need to register in both states. But a lot of it has to do with things like nexus and those start getting into some kind of legal issues. Like, for example, do you have employees? What kind of revenue do you have? Do you have a physical address? Those types of questions kind of need to be discussed with an attorney to determine whether you have nexus and should be registering those states.
And the third question is, if we're making payments to offshore consultants, do we consider those as expenses rather than other account?
Yes. Yes, well, it would kind of depend on the relationship. But if I'm hearing you correctly, let's say, for example, you have a contractor that you hired that is doing some work for you in another country, and they send you an invoice. Yes, obviously, when you pay those or when you enter those in your system, they will show up as whatever kind of expense it is, whether it's a marketing expense or an R&D expense or whatever service they're providing. Yes, that would be a corporate expense in most cases. Now, if you have some sort of a different type of relationship, where example they're a partner, and they have they have some ownership of the company, for example, then that starts getting a little bit more sticky, a little bit more complicated, and again, I would kind of encourage you to speak with legal counsel to just make sure that you're doing things correctly.
Great, thank you.
Sure thing. So now we're kind of, now we're at the stage where, okay, we got the company going, and we are now, ready to, maybe go out and try to get some fundraising from external. And here we'll just touch upon this a little bit. We'll touch upon kind of, what you need to be doing in terms of prep. But the goal and the meat of this webinar is not about fundraising. I would encourage you to, go to our website or our YouTube channel. We have lots and lots of previous presentations where we focused on different aspects of fundraising, and I'm sure you'll be able to get a lot more detailed information at those places. But we'll just kind of touch upon just a couple of things here. Just to make sure that we're all on the same page. For fundraising prep, and when we say fundraising, basically you're talking about going outside and looking for investors who are going to invest in your company to help the company grow and to hopefully reap some financial rewards on the back end. And for that, you really need three main things, right? You need an executive summary, you need a pitch deck, and you need an elevator pitch. And maybe we should have put the elevator pitch up on top because that's kind of the first thing. The elevator pitch is kind of where that classic, you get stuck in an elevator, you're going up 10 floors, and someone turns to you and says, so what do you do, right? So you have 30 to 60 seconds to basically say what you do, and that should be something that kind of, hits home as to what your company is about, and hopefully gain some interest and have the person on the receiving end, pique their interest to maybe find out a little bit more. The executive summary is a 1 to 2 pager that has some information about the company, like how long you've been in business, what do you do, maybe a little bit on the market, potential market size. This is probably going to be the first thing that you send out to anyone who says, hey, listen, send me a little bit of information about your company because I may be interested, or I may have other people who might be interested in potentially looking at you as an investment. And this is kind of the first thing that you would send out. And then the last thing is the pitch deck, and this is kind of the big presentation that you would be using not only to send out to potential investors who are more serious and want more information than an executive summary, but this is also going to be the slide set that you use when you actually get in front of potential investors to pitch your idea. And so let's go to the next slide, Patty, and we'll just look at just some examples. And for a pitch deck, I'll just kind of suffice this to say that there's obviously no set formula in terms of what you want to be doing, but some kind of key takeaways that I would say to focus on are things like try to keep it simple. Try not to use too many words. Use charts and use charts and photos much more so than bullet points. You want to try to keep the number of slides down to 10 or 12. Which is a kind of the classic recommendation from most experienced investors and entrepreneurs. These are some. Here's an example pitch deck that uses 10 slides, and you can kind of see, what those slides are. Obviously, depending on your company, you might have, different slides. You might have a demo slide in there. You might have a little bit more in terms of, explaining the problem or your solution. But in any case, you want to try to keep it high level and something that, where an investor is going to look at it. You're going to want to send it to them before you do the presentation. information. And so you want to kind of, make it compelling, make it visually compelling as well, something that's easy for them to read, but also something that leaves a little bit, out, right? That you really want, gives you an opportunity to make a pitch when you're actually in front of them, showing the slides and talking through the slides. Okay, and part of, and this is kind of why we touched upon on fundraising slides. Obviously, from an accounting perspective, funding, the financials related to funding is a big deal, right? And so, one of the big questions that we get is, okay, well, how do we present what the financials are when we're putting together these fundraising slides? And so we'll talk a little bit about that. So if we could go to the next slide, Patty. And really, there's two parts to it, right? So what you want to do is you want to show a compelling case, to your potential investors as to why this is going to be a great investment for them to be making. And a lot of it is going to be on things like, their confidence in you, how well you come across, how well you know the industry, how well you know the space, how much experience you have, your other team members that you have, that you're bringing to bear on the problem and solution, and all of that is obviously critical. But make no mistake, financials is a key part of this, right? Ultimately, it's going to be your financial performance that is going to drive the returns that the investor is going to have. And so you need to put together a set of financial projections that is both compelling to your investors in terms of the long-term growth, but also it conveys your understanding, right, and your confidence in your knowledge of the industry, your knowledge of your company, your knowledge of the needs that your company has, the opportunities it has, and all of that kind of comes together in a financial projection. And so, that's kind of, the next couple of slides is just, a high level view on this. As with fundraising, foundational information, we have a lot of presentations, webinar presentations that we've put together that looks at, how to put together different types of financial projections, budgets, as well as long-term plans, fundraising, financial plans. And so we again encourage you to spend a little bit of time on our website or on our YouTube channel to see if you might be able to get some more detailed information. But basically, you have basically two ways of looking at financial projections. You have a top-down financial projection and a bottom-up, and we kind of use, the top-down to try to, look at, what a potential, market opportunity or revenue opportunity our company has. So if this is your first round of financing, then you may have a little bit of history, you may have a little bit of revenue, or you may still be in product development mode, market research mode, and you may not have a lot of history, right? And so especially if you don't, then you don't have history to go on to say, hey, listen, based upon the historical and looking out, we can expect this kind of growth in terms of revenue, and this kind of growth in headcount and expenses, and so here's our financial plan. Most companies at an early stage, they don't have that information, right? And so what you want to do is you kind of want to start with, this upside down, this funnel, and we use, you'll see acronyms such as TAM, which is the total available market, which is, this upper portion of this funnel here, which is the total market size, right? Of our business or of our product or service. And you start narrowing that down, right? So you start narrowing it down, you go from total available market to a serviceable available market. So for example, if you have a total available market that is global, right? Well, maybe if maybe your initial reach is to the United States, or maybe it's even more geographically smaller than that. And so you kind of whittle that down to an initial segment or geography that you're going after, and you keep on extrapolating that down until you get to what we would say is a SOM, right, which is a serviceable obtainable market. Right, and that is kind of like your first product, your first service, the thing that you're focusing on, the thing that this initial set of investors is ultimately investing in, this is the product, this is the service we're offering, and this is the market size that we're going after. With this first product or service. Now, you may have, and you should have, obviously, much grander plans as you grow the company. But you're obviously not going to, raise $1 billion in your first round of financing to go after, Google, for example, right? So you want to whittle it down to an initial segment that you're going after, and you have a market size. And from there, then you kind of extrapolate out. Okay, if we're successful, if we're able to meet our milestones, and if we bring a product to market in the timing with the features and the benefits that we expect, then we think over the first 12 months, 24 months, 36 months, we think that we're going to be able to generate a certain amount of market share, which should kind of whittle down to a revenue over that time period. And that's kind of what a top-down financial projection gives us. Then if we go to the next slide, from there, and this is kind of where now, and that initial the tops down, I would say is more of a you as an entrepreneur, you as a founder, you as an industry expert in the space that you're in, that is probably data that you either can research, have good ideas about, and so that's going to be a lot on you, right, to kind of come up with that revenue plan. Then from there, then I would say this is kind of where, now we start, doing a little bit more of a bottom-up financial projection, where you say, okay, well, this is the kind of, these are the, not only looking at the revenue and what we need to generate that revenue, but what kind of resources do we need? Right. So what kind of headcount are we going to need? When are we going to need that headcount? How many developers do we need to hire? When? When do we need to start hiring salespeople or marketing people? When are we going to have an organization that's going to be big enough that we need to start hiring support staff? Do we need to to purchase fixed assets? When are we going to need office space if we don't have office space? How big of an office space are we going to need? All of those are the kinds of things that you should be thinking about, and hopefully having someone help you, who's knowledgeable and experienced in putting together this kind of expense plan that can support the revenue, right? So it's not only the people, it's not only the resources, it's not only the space, it's not only the fixed assets, it's not only other types of expenses, but it may be inventory. It may be KPIs, or it may be certain types of determinants of success. So for example, for a SaaS company, or a service as software as a service company, you're going to want to look at some of your KPIs, such as customer acquisition cost and churn and lifetime value of your customer, and those kinds of things to help you determine what kind of spending you're going to need in order to basically be able to support the revenue that you are suggesting that you're going to get. And then, for this kind of plan, you probably want to do it over a 3-year period. You just want to make sure that, obviously looking out, 5, 10 years down the line is probably a little bit early. Most investors want to see what your plans are for the next 18 to 36 months, because that's usually how long, like 18 to 24 months is how long an initial round of financing should get you, and you should be looking at what you want to be generating in terms of revenue, what kind of milestones you want to be hitting with that financing. Okay, so sorry for going through that really, really quickly. Wanted to make sure that we got through that, at least a high level. But again, encourage you to spend a little bit more time looking at some of the more detailed presentations that we've done in those areas. Okay, so now post-funding, and this is kind of where now we're at the stage where we have outside investors. They have certain they're going to have certain demands and requirements from us from a reporting perspective and an accounting perspective, right? And so, prior to you getting financing, you might have been just kind of keeping your expenses, in a spreadsheet, or you might have been using QuickBooks or Xero, but you're really entering transactions on a cash basis, right? So when you send a check, you enter that check. When you bring in revenue, when someone sends us a payment, you log that in as revenue. That is no longer going to be sufficient for you as you start reporting to investors. And if you have a board member, or if you have a board, the reporting that you do to the board requires more than you've been doing. If you are, in addition to getting equity financing, if you've taken on some additional debt, maybe some bank loans, maybe some venture debt, then their reporting requirements are also very, very different. And now we start getting into more of kind of like technical accounting. And here we start with generally accepted accounting principles, or GAAP. Right, and GAAP is basically a set of rules that are used so that that companies, similar type of companies, are reporting their financials in a similar manner, right? So it allows investors, it allows outsiders to view your financials and compare them against other companies in similar spaces, and using the same GAAP principles, so that they can feel confident that the financials that they're seeing from us is done properly. Right, and some of these main things are accrual versus cash accounting, and so when I kind of touched upon cash accounting previously, and that is where basically everything that we're doing is cash based. And for a lot of companies, for mom and pop companies, for consulting companies, that may be very appropriate. You only care about cash coming in and cash going out, and so revenue is recognized when cash comes in, and expenses are recognized when cash is paid out. But for investors and for companies with ultimately growth plans that go beyond just kind of ma and pa cash based accounting, then we are going to want to use accrual based accounting. And accrual based accounting basically says that revenue is recognized when it is earned, not when cash is received. And expenses are recognized also when they are incurred and not when they are paid out. So two classic examples of revenue in this case would be, for example, for again, a SaaS company. So let's say we have a software as a service, and we offer two types of subscription models, right? Maybe we offer where people could pay on a monthly basis. So let's say they pay us $100 per month. Right. Well, that's pretty simple, because we charge them $100 in January, and they use that service for January, and then we get paid again in February, and that's great. But let's say for that same person, we offer them a discount so that they are able to purchase a year in advance, and they pay us $1,000. So they get a discount, right? They get whatever that discount is, $200 discount to prepay for the year. Well, if we're using cash-based accounting, we would take $1,000 of revenue in January when we receive it. But that is obviously not correct, because we haven't earned that revenue yet, right? We still owe that service to the person for a 12-month period. And so rather than accounting for $1,000 on day one, we would recognize $1,000 of that revenue over the life of that subscription period, or in this case, 12 months. And then the other thing on the other side, if you have a business where you are giving terms to a customer, and when they purchase something, we ship them a product, or we provide service to them, and we send them an invoice, and we give them terms of 30 days to pay, and so we actually don't see that cash coming in until a month later. Well, we've actually earned that cash in this period, and so we should be recognizing that revenue in this period, as opposed to when we receive the cash in the next period. Okay, so as we kind of start thinking about what do we need to put in place to be able to do our accounting under GAAP principles, then there's going to be some things like obviously a chart of accounts, and so here's several chart of account titles. these are balance sheet accounts. You're also going to have, some accounts for, for your income statement or profit and loss statement. So revenue, cost of goods sold, different types of expense categories. And so, all of this will be set up for you, or you'll set them up, when you start using an accounting system like QuickBooks, which by this point, you absolutely need to be using. Okay, so next slide, we'll just touch upon, just some very, very simple financial statements, that will be easy to generate, from QuickBooks or Xero or whatever accounting system you use. So assuming that you've entered your transactions incorrectly, then here's obviously a very, very simple income statement, where it has revenue. There's probably one, category here that's missing, which is cost of goods sold. So that the cost associated with the revenue that's being generated, which would get us to a gross margin number. And then you back out of that, basically all of our operating expenses. So here's, 3 examples here, which gets us to, total expenses. And then you subtract that out of gross profit and you get a net income for the period. So in this case, it's for the year ending December 31st, 2012. But you'll be able to run this report for, on a monthly basis, quarterly basis, annual basis. Again, using something like QuickBooks will be very, very easy to generate. The second main financial statement is the balance sheet. And this, as you can see from this very simple example, it balances, and that's why it's called a balance sheet, right? So, assets equals liabilities plus shareholder equity. And so you can see, some numbers here, cash, other types of assets on the left side of the ledger, and then on the right side of the ledger, there's liabilities or things that you owe, as well as all the equity that you and other shareholders have. And this is something that it has to balance. There's just no way that it cannot balance unless you're making an error somewhere along the line in terms of how you are entering data. But I'll say, and another reason why you want to use an accounting software such as QuickBooks doesn't allow you to make the error of having a balance sheet that doesn't balance. It's just impossible to do, and it'll error out when you make an entry and you try to make an entry that's ultimately going to make the balance sheet not balance. QuickBooks won't even let you do it. So it'll tell you that there's an error and you need to fix it when you're actually entering the transaction. The final, and this is one where this one's a little bit. It's a little bit harder for some folks to understand, especially if you're kind of new at this and you're not an accountant and you've been doing things on a cash flow basis. Then as you move to an accrual basis, basically what the statement of cash flows does is it kind of marries your P&L and your balance sheet to determine what's happening with cash. So as you can imagine, like we use that example of the $1,000 of revenue for a SaaS company. Well, you received $1,000 cash, but you only recognize $83 in revenue in January, right? And so your income statement is only going to show $83 of revenue as opposed to $1,000. And so you're compared to a cash flow based income statement, you're going to show much less net income, obviously. And then when you compare that with what's happening with cash, you're going to go, oh, this looks really, really strange because we have a lot more cash than what our income statement is showing. And what the statement of cash flows is, it kind of marries your P&L or your income statement and what happened from a GAAP-based revenue and income statement versus what is happening with your balance sheet and changes that's happening on your balance sheet accounts. So in this case, for example, cash and some of the accrued liabilities and accrued expenses that you're putting on, and it kind of marries them together to show basically what happened to your cash. And so obviously for all of us who are focused on cash, and we all should be focused on cash, understanding what's happening with cash is critical. It's a little bit harder to see what's happening if you're using GAAP-based income statements. And so the statement of cash flows is the one that, that any CFO or anybody with a financial bent and all entrepreneurs, we should be really, really spending a good amount of time on what's happening with our statement of cash flows to figure out what's happening with the business. And speaking of cash, this is one where this isn't necessarily an accounting thing, but we are strong believers in obviously understanding exactly what is happening with cash. Unless you're a company that is already profitable and generating cash, for most of our clients who are venture backed, they'll get started, they'll raise some money, they'll spend that money, they're trying to develop the market, they're trying to develop their product, they're expending cash as they go, and so they're in a negative cash flow position on a monthly basis, and they expect to be for a certain amount of time, right? Until all the investment that we're putting in starts to throw off more cash than we're expending, and so keeping our eye on what's happening with cash, how much cash we are burning on a monthly basis, our runway or our time to live on the cash that we have. That is a number that we as entrepreneurs and we as managers of our company and we as stakeholders in the company have to know always at the tip of our tongue, right? So when an investor calls and they say, hey, what's happening with cash? We need to know what our cash position is. We need to know how much time we have to live. We need to know when we need to start our next round of financing. We need to know if we're spending too much money and our cash is not going to last us as long as it needs for us to meet our milestones. All of those things are things that as an entrepreneur, as a manager, are really, really the most critical things for you to know. The rest of the stuff, the balance sheet, making sure the transactions get entered into QuickBooks properly and all that is part of it. But all of that leads to this, right? Which is, how much cash are we burning? What kind of cash burn requirements do we have in the future? Are we meeting our milestones in terms of customer acquisitions or product development? Do we have confidence that our cash is gonna last us as long as it needs to last us? And are we in a position that we're able to raise our next round of financing easily and at a good valuation? And are we able to raise the right amount of money going forward? And so understanding our cash burn is critical, and having some sort of an ongoing chart like this, which shows what has happened with cash over the past 12 months, and I would even say let's put in what we expect in terms of our cash flow burn over the next 6 to 12 months to give us a much better idea of when we think cash is going to run out. That is really, really critical and something that you should be working to put together as you're thinking about your systems.
Sirk, we have some questions.
Absolutely.
When there are checks in the payment, is that considered accrual or cash basis?
Oh, so when there, so you're saying that, for example, someone sends us a bill and we have 30 days to pay. So, like, for example, let's say a professional services, so a law firm, for example, right? So in January, we worked with a law firm, and at the end of the month, they send us a bill for $1,000, for example. We would enter that in as a January expense, and it would show up at the end of January as a payable. Right, so the expense is recognized in January because that's when the service was rendered, and obviously we haven't paid the cash out yet because they send us an invoice and we have 30 days to pay it or whatever, and so we won't be paying it until February, but it shows up on our books as an accounts payable on the balance sheet, and it shows up as an expense on the income statement. Likewise, and this is kind of, so for when someone sends us an invoice, that's easy, right? We enter that in. But this is the key thing that I want us to take away. There are going to be those situations where we don't get an invoice, right? Where we know that we worked with somebody, maybe a consultant or what have you, and at the end of the month they don't invoice us. Maybe they're just not very good at invoicing. Maybe they invoice us every other month or whenever they get around to it. We know that we incur those expenses, right? We need to show that on our income statement as an expense that we incurred in that month. And so I think this may be what the question is we would want to record that expense, even though we don't have the invoice. we would want to record that as an expense in our accounting system as an expense. And then again, because we don't have an invoice and because it's not an accounts payable at this point, we would want to put that on our balance sheet as an accrued expense.
We have another question. It
Yes.
says, how often should we be updating these statements? Example, cash burn, income statement, etc.
I would say monthly. Now, so we always look at things on a monthly basis, right? If you have much tighter, cash flow requirements and you're kind of working almost like, bill to bill and invoice to invoice, then you might want to do it more often than that on the cash flow basis. For those who are, for whom, cash flow isn't a big issue and they don't want to spend the time, they want to focus their energies on customer acquisitions and providing service and whatnot. If you feel like you can get away with it and do it on a quarterly basis, that's fine. It's kind of up to us. But in most cases, it's on a monthly basis.
Thank you.
Sure thing. Okay, and then we'll just kind of touch upon define some final things that we want to make sure as after we get our financing in place and after we've kind of got an accounting system and we're now generating financial reports, we'll obviously want to do some budgeting and financial planning. And for budgeting and financial planning, we'll just touch upon a few key things, here, which is that, for most financial planning processes, I would say that, 5 to 10 key variables, it really drives 95% of the financial plan, right? So focus on what those key variables are. Think about kind of what are the big drivers that's going to drive our business and our financials, and focus on those. There's going to be lots of other things like office expenses and maybe some T&E or travel and entertainment that you want to throw in there to make sure you captured it, but that's not going to really drive our financial plan. It's going to be about revenue growth. It's going to be about customer acquisition costs. It's going to be about headcount planning, right? Those are kind of the main things. Marketing spend, advertising spend. Those are the kind of the things that you want to focus on as your key variables that's going to drive your model. And obviously on the revenue side, similarly, you'll, based upon your business, you'll know what the key assumptions and variables are that's going to drive your revenue assumptions or revenue numbers. Run different scenarios, right? I'm a big fan of doing an expected case, best case, and worst case, or expected case, better case, and lesser case, right? So that you kind of understand, where we're trying to drive towards. What do we do if things turn out better? Do we, increase our spending, or do we increase our headcount planning? What happens if the revenue doesn't come in like we expected? What happens if product development is slower, and we have to make our cash last longer? Then what do we do? So run different scenarios, and keep those different scenarios running in the background as you kind of go along, so that you kind of know what where things stand. And then, for a long-term planning, I would say you want to do, 1 year planning on a monthly basis, and then you probably want to forecast on a 3-year plan, or a long-term plan, either on a monthly or quarterly basis. Okay, so internal controls, and this is a key one. Your investors are really going to be honed in on this. They want to make sure that the investment they've made is safe, right, with you. And so part of that is the financial reporting, the monthly package that you're going to be sending to them that shows, GAAP-based accounting and financial statements. They'll be able to peruse that and and from that they'll glean a lot of information. But they'll also want to make sure that that we have the right controls in place, right? So control who has access to financials, and who has access to bank accounts and credit cards and payroll. Obviously, you want to limit the number of people who have access to be able to spend money on our behalf, or transact business on our behalf, or send money, write checks, or send wires on behalf of the company. You want to keep that to a minimum. You really want to have a check and balance in place where one person prints the checks and another person signs. You don't want the same person doing both or being able to do both, because that's obviously when potential fraud happens. And so to the extent possible, you want to have separation of duties and responsibilities, and then the same thing on the approvals process. So one of the things that we like to use for our clients is we like to use things like bill.com, right, where an invoice comes in, it gets logged into the system, someone goes in, checks it, approves it to be paid, and then someone else, maybe the CEO or CFO goes in, looks at all the bills that are being approved to be paid, and then go ahead and approves the payment to be made. Second to last slide here, and I know we're kind of running up on time, but just really quickly, accounting systems. So we talked about QuickBooks or Xero. We definitely want to be using something like that. We want to have a system in place for accounts payable. So invoices or bills that are coming in, we want to make sure that that when we send out invoices, that we have an accounts receivable function that's working well, making sure that we're checking our accounts receivable balances, making sure that no accounts are outstanding for too long. We want to be paying people that we need to be paying on a timely basis. We want to be obviously making sure that we're accounting for expenses internally, both from a corporate perspective as well as if we have employees who are sending in expense reports for their own spending on our behalf of the company. We need to be taking care of that, and payroll, obviously payroll. So so some of the systems that I'll touch upon: QuickBooks or Xero. QuickBooks preferred from our perspective for accounting. Something like bill.com for accounts payable and even accounts receivable. You want to use something like Expensify. We like Expensify for expense reporting, and then there's a whole host of payroll service providers like Gusto, that are available to you. All of these are basically SaaS companies, right? So you don't have to invest in a lot of infrastructure or software. You just kind of sign up and use on an as needed monthly basis. And then the final thing that we want to touch upon, and this is going to again apply to companies that have raised out external financing and have investors and have different classes of stock. So valuations, right? So valuations, what do we mean by that is, you obviously want to know what the value of your company is. Some of it can be subjective, but for the cases of where you have employees and you are giving stock options to employees, right? Those stock options have to be priced fairly. And in order to be priced fairly, really the only acceptable way, as far as the IRS is concerned, the SEC is concerned, is for you to value your company and value the common stock by a separate entity, right? And so there are companies that do this. We provide that service. There are other companies that do it. I think some of the equity or cap table companies such as Carta, they do it. But basically, what it does is it kind of goes through this process of trying to figure out what the value of the common stock is at any point in time, so that when you are giving stock options and you're pricing the stock options with a strike price that is appropriate, that you have confidence, that the employee has confidence, and any outsiders, they have confidence that that stock has been priced properly, and that there's no there's no shenanigans going on, that there's no that there aren't stock options that are being priced too low, for your state of the business, which can potentially cause problems not only to you and your company, but also to the person who's receiving those stock options. And so, we encourage you to kind of look around, but this is something that has to be done, at an absolute minimum on an annual basis. And then also, in addition to that, you need to be doing it, if there's any kind of a big change in your business. And typically this, means like financing round, upon the close of a finance round, you're going to want to do another valuation of the company so that your stock, your common stock, is priced properly. So I apologize, it ran a little bit long, but I'm happy to hang out for a little bit longer if there are any other questions that you have. I think Patty I think Patty, do you want to just go ahead and close up and let them know kind of what they can expect going forward?
Yes, sir. Thank you so much for presenting today. We're running a little bit out of time, so all the questions that we didn't answer, please email us and we'll try to answer them as soon as possible. Just a reminder, I will be sending an email today or tomorrow with the webinar recording, the presentation in a PDF, and Sirk's contact email, so you can contact him or me with any information. And thank you so much for everyone that attended, and thank you, Sirk, again.
Oh, and actually, there's a couple of questions that I see coming through here, and I can just answer those really, really quickly. Big
Perfect.
Four, and sorry for not getting into that. Big Four is the Big Four accounting firms, Pricewaterhouse, and I forget, it used to be the Big Eight, then it turned into the Big Six, and now it's the Big Four accounting firms. The 83B election, someone asked about 83B elections. Yes, so the 83B election is a filing that we make with IRS, whereby it has to do with stock ownership and stock that's being given, especially as we are as we exercise our stock options. That is probably a little bit more detailed than we want to get into on this call. But yes, to the extent that you are exercising stock options, especially prior to the investing, you will absolutely want to file an 83B election. And then, what version of QuickBooks will generate all the chart of accounts? They all will.
Perfect. I guess there's no more questions. Thank you, Sir, so much for answering all of these questions. And once again, if you have any other questions, let us know. I will be sending an email later tonight or tomorrow. Okay, bye.
Thank you all again.